Good morning, everyone. I'm Millie Hong, Head of Events at ASIFMA. Thank you very much for joining us today at this virtual event, COVID-19, Navigating the New Normal for the Finance Industry. Let me introduce our host and moderator, Mr. Mark Austin, CEO of ASIFMA. Mark, over to you, please.
Thank you very much, Millie. I'm really happy to be here today. I think we've got a great lineup, two opening speakers, plus a panel on navigating the new normal for the finance industry. Before getting into it, just a few housekeeping notes. We also wanted to thank ASIFMA and the European Chamber of Commerce in Hong Kong for endorsing this event. And then also before we begin, I would suggest that you put yourself in the full screen mode for the best viewing experience. In addition, just a very brief introduction to the three sessions, which I'll introduce a bit more detail later. The first one is an introduction on the impact of COVID-19 from Dr. Fahmy. Then we're going to follow with a global trends on the post-pandemic from Parag Khanna. And then we have the panel navigating the new normal for the finance industry starting around 11:30. This event, just for your information, is being recorded and it will be on a demand link after the event is finished from our website. So now I want to take the time to introduce our first speaker, and that is Dr. Ahmed Fahmy, who's a medical doctor with the International SOS. And Dr. Fahmy is going to speak for the next 15 minutes around the impact on COVID-19 over the next 18 months and the various options around that, which is going to set us up for the rest of the panel. So over to you, Dr. Fahmy.
Thank you. Thank you very much, Mark, and good morning, ladies and gentlemen. I'm very happy to be here. Talking about navigating the new normal and listening to the experts, primarily the epidemiologists and the virologists. I think lately a lot of their concerns, answering the concerns of decision makers in our respective countries, is how to actually open up the economy again. So in the next 15 minutes, I'm going to try to talk a bit about a few subjects that are kind of eventually of a concern moving forward, well, maybe have a few points that takeaway points for everybody here. Next slide, please. So just to give you a snapshot as of yesterday on where we stand, that's coming here from the Johns Hopkins University. And as you can see, we have more than 5,500,000 confirmed cases. Probably the real number of cases could be as many as 10 times more, but that's difficult to say. And you'll see that the amount of the number of people who died has approached 350,000, with the new numbers actually being fairly steady now. And I can tell you there's not a number that you see here. The total recovery rate is as of today around 42–43%. So the growth is less exponential than it used to be. Next slide, please. I thought that's an interesting slide to share with you that is coming from the European Center of Disease Control. And what does it really show? It doesn't show the total number of cases. It shows the 14 days cumulative number. And for me, it's just to share with you where actually the epicenters are. The epicenter has shifted gradually from Asia, China, to Europe, to North America, and now North America and South America, as you know, was still quite a high number of cases in Russia, but these are also on a number of new cases also coming down on a daily basis. Next slide, please. That's a map of the world according to International SOS. And I thought it's interesting to share with you because it gives a little bit of a glimpse of hope as well. So in red, and it's a pandemic, it's all the countries with local outbreaks and epidemics. The blue countries, and I thought that was the interesting one, are the so-called waning countries. That means the countries with a fairly low number of cases, of new cases, not on total cases, of new cases. So they're actually countries that I would almost say are recovering. And the good news, there are more and more. And in Asia, for example, there are countries such as Thailand, China, Hong Kong, Korea, that actually, if I may use a medical term, maybe on the mend. Next slide, please. So what has troubled us and what has actually influenced significantly our lives, if I don't take Hong Kong only, but across the region, across the world, are these so-called lockdowns, with, of course, the most famous one, the first one in Wuhan and Hubei. But almost all the countries have, to a certain degree, had some degree of lockdown and social restrictions with variable policies. And a lot of them were also due to the uncertainties. One must not forget that COVID-19, due to this new coronavirus, the SARS coronavirus 2, has, in the last 6 months, given us a lot of discoveries. We have discovered a lot about it, but there is still a lot of unknown and a lot that needs to be understood about the virus. The lockdowns, depending on how stringent they were, had severe economic impact, to state the obvious. And even in places where there was no severe or stringent lockdown, the fact that other main countries or important countries were in lockdown had an indirect impact on economies that were doing business with these countries. From my point of view, one of the key takeaways that I've seen is that to a variable extent, the repercussions or the consequences of the lockdown have had quite important influence and implication with regards to mental health of population, whether these are employees, families, even children were affected. And as a matter of fact, the WHO has also said and reported that there had been a significant increase in mental health issues over the last couple of months. Now, moving forward, I think we all agree that nobody really wants to return to lockdowns in the sense of, or in the form of what we've seen in countries, not only in China, but also in places like Europe and other places, even Singapore. And there is an institute in Germany, the Helmholtz Institute, worked with a finance institute called the IFO Institute in Munich, if I'm not mistaken, and has come to a conclusion through different modeling, epidemiological modeling combined with financial modeling, and came to this conclusion that the strategy of prudent step-by-step relaxation is preferable, not only in terms of health policy, but also economically. What does that mean? It means that there are two extremes. Either you open up the society, the economy, without any control, and eventually it's good for the economy, but you'll see eventually cases flare up again, and medically it could potentially lead to a disaster that then in turn would have detrimental effects to the economy. You could also have the other extreme where you would have an extremely stringent lockdown with a very stringent control, which would bring the cases down, but it would affect and damage, and we've seen it, enormously the economy. So they came with a modeling where the best is somewhere in between, where you would have a certain amount of cases that can be managed fairly well by the healthcare systems, but it doesn't damage too much the economy. And I thought it's a very interesting approach that shows also that decisions are not only in the hands of experts like epidemiologists, but decisions need to be done by a multitude of people that are influencing social life and economic life. So the question then, when should countries actually lift lockdowns, or should they do that? It will depend, amongst other, whether the epidemic is controlled, how good their healthcare system is, how good the capacity is to monitor new cases and to respond to possible flare-ups or resurgence of cases. And also the possibility to protect vulnerable population, which is very important because you know that the elderly are the most vulnerable. And whether the economic actors, the workplaces, have preventive measures in place and are well established. And last but not least, that communities are well and fully engaged. Under all these circumstances, coming down with the lockdowns will prevent us to eventually having to go to stringent lockdowns again. So the principle here is lift and be ready to suppress again, but if all what I just said is kind of followed and is met, that suppression may be fairly limited and there's maybe no need for very stringent lockdowns. It takes into account, and I thought it's very important to share this with you, the responsibility of the citizen. And maybe from our angle as employers, assistance companies, etc., how can we actually help to bring the message to each individual citizen to act as a responsible citizen so that, again, lockdowns to a certain degree can be avoided moving forward should there be a flare-up again. And as long as we have not found a treatment and a vaccine, non-pharmaceutical measures will need to be continued. And these are the ones that you probably already know, be it going from hand washing, as simple as that, individual hygiene, to social physical distancing. I won't go into the details here again in the interest of time. Next slide, please.
Hey, Dr. Fahmy, it's Mark Austin here. I think you got about 3 minutes left. So I know you still got quite a bit to cover. So I just wanted to let you know that. Thanks.
So very quickly on treatment, there are several treatments that are going to be on trial under so-called WHO Solidarity Trial. One has been taken out actually in the last couple of days because of the side effects, which is the hydroxychloroquine. And vaccine development is looking so far kind of promising with two main vaccines that are entering the so-called phase 2 trials. Next slide, please. Next slide. So, question that everybody has is, are we over it, or is there going to be something called the second wave or another peak? The Prime Minister of Korea said it's not over until it's over. And the concerns are multifold. Number one, the population overall is still vulnerable because there are not that many people who have been actually developing antibodies. The virus is still present. Asymptomatic cases can transmit the disease, so we don't see them. And there are, because of what we've seen with the lockdowns, there are also compliance issues. So second waves, how strong they're going to be, there will be second waves of resurgences. It will all depend on the quality of the healthcare and how quickly it can be detected. And that will then depend on whether there are small clusters or large outbreaks. And whether that's going to then cross borders and be global will also depend on how quickly we can contain it locally by testing, isolating people, contact tracing, and the quality of the healthcare system, but also, again, as I said, by how disciplined and compliant people will be. So early intervention to control these second waves is going to be key. And we've seen that been quite kind of successful in places like China recently, in Hubei, even in Korea. So early intervention and all these measures are going to help us hopefully to contain very early until when would we not have any waves anymore, as I said, vaccines and treatment. Next slide, please. Next slide, no, this next one. Next one. Yeah, here you see possible scenarios. I won't comment to that. Next slide, please. So traveling, that's another concern that people have, is when can we travel again? The situation is that air travel has obviously collapsed, and that due to travel restrictions, government decisions. But we see now bubbles that we call that bubbles between countries where there are bilateral agreement allowing business again, China, South Korea, Finland, Poland, Australia, New Zealand, etc. And what we'll see first is probably going to be domestic air travel. And what's going to be very important from a medical point of view is how well the system is going to be in place to protect the individual from any infection. So it's from your perspective, important to evaluate the importance of air travel and if it's really important in your business continuity and your business in general, and if you and then for you to review your policies. Then I strongly suggest people to look at where they go, their destination location, and look at the risk related to these countries, whether it's the restrictions, the medical risk, how bad is the epidemic there, and what is the quality of healthcare. And keep always informed about the pandemic in general and in particular where you're traveling. And then travel safe, having your basic hygiene measures, public health measures, but also when you travel is avoiding crowds, maybe, and I'm trying to be short here, being as practical as doing online check-in, taking seats rather near a window than near a galley to avoid, being too much in touch with crowds, limiting displacements, and always having the possibility to, wash your hands and wear a mask all along your travel. Next slide, please. Interesting here is, as we surveyed people who said they want, to 83% want to resume travel as soon as restrictions are lifted within, a couple of weeks or a couple of months. And here are the main destinations where they want to go and travel. And China is obviously one of the #1 destination where they want to go and travel. Next slide, please. And so what will you eventually encounter? Pre-flight, be prepared, as I mentioned earlier, but you'll have probably a new experience in the airports. There may be much more delays due to screening, questionnaires. Eventually, even some of the airports are looking at testing, rapid tests being now in circulations. You've probably heard about immunity passports, which have been discussed, but at the moment are put on hold. People may ask for your immunization. There's going to be QR codes that are going to be requested to let people fly. Obviously, as I mentioned, during the flights and during the whole journey, PPEs, whether it's masks or hand gels, are going to be the new normal. Embarking and disembarking is going to follow very strict rules in order to avoid having too big crowds and avoid close contacts. Seatings are going to be reviewed, and that's going to probably change the industry. Limited services in terms of meals that are going to be served, and how we're going to handle people that turn out to have fever or symptoms while they're traveling. And at the destination, you have to be prepared with much longer processes that are going to screen yourself, going to look where you're coming from, fill in additional questionnaires, eventually then going to channel you to dedicated centers, again, depending on the destination. But obviously, travel by air is going to be way more lengthy and tedious and procedural than it used to be. And I think people need to get prepared for that. IATA has actually recommended, if possible, to have as much as possible done in terms of testing, questionnaires, and preparing before people even enter an airport to decrease this burden on the airports and the airlines. But that's still not fixed yet, but that's probably a space to watch moving forward. I think probably was a bit over the time. There's a lot to say actually on each of these subjects, but I hope I summarized it well.
Thank you very much, Dr. Fahmy, and really a really great overview of where we've got to with the virus and what we can expect going forward, both in terms of the overall macro case load, but also in terms of what we can expect in things around business travel, etc. So I think that sets us up really, really well for Parag Khanna, who's going to talk a little bit about how the world will look in a post-pandemic environment. So over to you, Parag.
Great, thank you so much, Mark. So in the interest of time, let me jump right in and pick right up on the heels of what the doctor was saying. When he mentioned bubbles, right, we've been hearing this term, pairs of countries. I'm thinking now, taking a big step back macroeconomically in terms of where the world economy and even really our global order is going. There are certain trends that began before the pandemic that I think are going to be reinforced. So let me just highlight a few of those to set the stage, set the scene for the conversation to come around some of the opportunities in the investment landscape. The first is regionalism. We've seen a rising regionalism or intensification of regional trade since before the COVID-19 pandemic, even before the trade war, really. But if we want to use the last couple of years of reference as a point of departure, then we can recall that owing to the trade war, already the United States had made Canada and Mexico its largest trading partners. Its trade with China had shrunk to a lower level than that between its neighbors. Now we also have an even stronger push for self-sufficiency, for shortening supply chains, nearshoring. Again, it's actually the shale energy revolution that had kicked off that conversation nearly a decade ago. But all of these things have really added, sort of one on top of the other. In Europe, we're following the news and seeing the efforts towards moving from just the monetary union towards a more fiscal union, sort of doing it by stealth as they are now with the consolidated bond purchasing program, as well as the huge package that's being offered on the fiscal side to bail out countries. So I think Europe as well, which already has majority of its trade internal, that's going to continue. And now looking at Asia on the right. Already most Asian trade was within Asia. We've seen that pairs of countries have incrementally deepened their trade relationships. Prior to the pandemic, most of the free trade negotiations going on in the world were between Asian countries and so forth. So, I think to the extent that we still have global supply chains as we move down the road, it's going to be the make where you sell, right? So make things in Asia that are going to be sold in Asia, but make things in North America that are going to be sold in North America and so forth. And you see that in technology, in the automotive sector, various hardware and so on, obviously pharmaceuticals as well, some of these strategic sensitive areas where countries want to make sure they have sufficient supply, that too will reinforce regionalism. Let's go to the next slide. And now here, just emphasizing the Asian opportunity. Again, think of Asia as in some ways a large bubble, or ideally at this point, it's just micro bubbles, just like you have between, Schengen area countries in Europe, but rather trying to embrace the technology that the doctor was just talking about. How can we internationalize the testing, tracing, the sort of immunity passports and so forth, so that more Asians can travel within Asia? Because of course that's already the case, and it's certainly, given the restrictions and limitations around transcontinental travel, that's going to be the case moving forward. Again, pre-pandemic, RCEP was a major issue the last couple of years. We saw governments push ahead with legislating it last fall, ratifying it at the moment. And there's a lot of momentum, a lot of potential in there, given that the US didn't join TPP. There was a greater push now with Japan over the last 5-6 years plus, diverting a lot of its foreign investment out of China into Southeast Asia. So you have really, based upon where in the technology curve or value added one looks, the high value added countries like Japan and South Korea are looking to more aggressively export some of their technologies, Internet of Things and so forth, to the developing countries. They've definitely, again, diverted FDI into ASEAN, to a lesser degree into India. But India, which did not formally join RCEP, does really want to deepen its trade ties, but by more in the direction of trying to reduce its deficits with East Asia. So I think that there is, as some have estimated, over the next 5 years, a $200 billion opportunity to deepen intra-regional trade in Asia and to enhance that self-sufficiency. So I'm bullish about this. Next slide, please. Another reason to be relatively optimistic about Asia, not least obviously because of the progress that's being made in many countries. Obviously, we shouldn't be complacent, and there's a lot of question marks out there, such as India. But generally speaking, what I think has been one of the areas of sort of confusion, if you will, or what hasn't helped is that since the MSCI index is so strongly driven by Asia, it's also pulled down by non-Asia. And I think we really do have to have a bit of that decoupling of concepts between a global EM category that includes the Turkeys and the South Africas and Argentinas of the world, the very fragile economies in terms of their outstanding US dollar debt, in terms of the volatility of their currencies, versus actually the geographic Asia and its ability to rebound. And we see that that has happened. So we've got, again, also Asian economies benefiting from low oil prices, the market reforms, the capital account liberalization that was underway, particularly in China's push. Now we know that that's heavily politicized, but that said, there is a strong appetite to continue to move into the onshore Chinese equity market. Again, what Japan has already done decades ago, South Korea as well. Now, certainly, China is seeking to do as well, draw in that portfolio capital. And then what China does is, of course, is that other developing, emerging Asian markets will want to copy that too, especially at a time when there has been portfolio capital pulled out of Asia to try to lure some of that back. So I expect, again, that it's time to kind of focus on, have more indices that are exclusively Asia focused that can help to draw some of that capital back in and increase it in moving into the future. Next slide, please. Great, so we've covered trade, we've covered capital markets. I'd like to just briefly mention energy. As I said, the fact that oil is low generally benefits, of course, these Asian economies, but also what's important is the push into renewables. Now, there is still a huge increase in the expected demand curve in Southeast Asia and high growth Asian markets around oil and gas imports. Now, the only way to, sort of break that trend, if you will, is to strengthen both the public and public sector support for renewable and alternative sources of energy in the region, as well as, of course, in the private sector side. And this, I think, is a very important investment opportunity, which I'm going to come back to in just a moment. But generally speaking, the poorer Asian countries obviously have a long way to go in terms of thinking about national, holistic, transformational energy strategies. I think this would be a very important time for them to do so. So here we talk about what can be done. Already within the Asian region broadly, there's a lot of leaders in that space, both on the financial side in terms of clean tech funds. You can go to that next slide, please, on the clean tech. Thank you. This is perfect. solar, battery, even hydrogen, and so forth. Australia is making a lot of investments in hydrogen. South Korea has already. The broader space around environmental technology that includes water desalination and so forth. There's a huge strength in nuclear as well. All of these are opportunities for Asia, particularly East Asia, Southeast Asia, to achieve a greater degree of regionally integrated energy markets, self-sufficiency, to depend less on oil and gas. So we know what benefits that's going to have for current accounts and in the long run for environmental sustainability. Next slide, please. Another important opportunity relates to health tech. So the doctor already mentioned some of this. We're following, obviously, every day what announcements there are in progress with vaccine trials, but generally speaking, we also see the gaps in health tech. Now, that means not only the obvious things around vaccines, pharmaceuticals, and drugs, where again, you know, what I think has been prominent and now more appreciated, obviously, is China and India's role in the pharmaceutical industry in terms of their generics. So that's clearly an investment opportunity. Then even in the medical device space, you know, sort of 3D printing medical devices, masks, PPE equipment, and so forth. Huge capacity in Asia to develop more in this industry for global benefit, for the global market, certainly for Asia itself. Telemedicine and telehealth. Because we know that providing broader access to healthcare for the very large population of Asians, for the bottom 50%, let's say, that's a couple of more than 2 billion people, is not going to be done through the huge CapEx kind of approach of the large hospitals and so forth. Rather, there's an opportunity to leapfrog to telemedicine. Here again, there's Chinese and Indian firms that are very strong. And others too. So I think these are all growth opportunities, investment opportunities in the health tech space. Next slide, please. Digital, perhaps, needless to say at this point, given how we are all interacting and conducting business. I'll make a macro point that at a national scale, wherever you may be, many countries had pledged to make substantial investments in national broadband implementation, but didn't do it, and really obviously wish they had prior to COVID-19. So it's a huge opportunity still around internet cabling, broadband, 5G, obviously as well, data centers. All of these that belong to the digital infrastructure asset class are going to benefit. And obviously the e-commerce companies, delivery and so forth that are on top of that. The technologies around remote work, remote collaboration, digital services, e-learning, entertainment, mobile payments as well, going cashless. We've heard just the other day that China, for example, wants to make sure that it's deployed its crypto instrument before the Olympics, nationwide. So I think this is another huge area, the digital asset class. Next slide, please. Let me talk a bit about real estate as well. Now, here, given that we've all been in this artificial lockdown, I think that one of the things that people are going to be looking at is both from a micro standpoint, what is their immediate 5-block radius, if you will, right? What is the quality of life there? Should there be another pandemic, a next wave, a lockdown, a quarantine, whatever, people will want to ensure that they're near green space, that they have all of the amenities that they require in their immediate radius, perhaps that they're living closer to friends, family, whatever the case may be. And I think that that is really going to lead to, obviously, a shakeup in residential real estate. Needless to say, with commercial real estate, there's a lot of stress right now and a need to restructure many of those assets. Within commercial real estate, what has been interesting is to see this distinction between essential and non-essential services and how those manifest in real estate. So those REITs that have high sustainability, that are obviously catering to the food sector, grocery stores, medical facilities, again, and the data industry, those are going to be critical, sort of asset classes within commercial real estate more broadly. Then looking at, again, residential, where do people want to live? Well, people want to move from places without good healthcare to places with good healthcare, right? From red zones, if you will, to green zones. Affordability is also going to be an issue given the financial pressure that many households are facing coming out of this crisis. So communities or provinces, cities, and others that are focused on affordable housing are also going to benefit in terms of attracting the next wave of pandemic migrants, you could call them, or climate migrants. So on that, let's go to the next slide, please. Here, so more broadly, why do people move? And I'll sort of these last two slides are a bit more, macro and almost philosophical, if you will, because they deal with human geography, which is really like climatology, but for people. So these are long-term trends that we're talking about. And if we map out the impact that climate change is having on our demographics, the impact it's having on agriculture, we start to see entirely different maps of what parts of the world are habitable and non-habitable. And I've looked at IPCC reports and other various data sources and had maps commissioned that really show various potential future geographies of habitation. This map is stylized indeed, but it does actually attempt to reflect the stable geographies of food production in the world if temperatures rise 4 degrees Celsius from the 1990 baseline. That's obviously an extreme scenario, but nothing seems too extreme anymore. So here, obviously, you see that Canada and Russia are producing all the food, but as you know, they're also two of the most depopulated countries in the world. Whereas the largest demographic concentrations in the world, of course, here in Asia in particular, but also other very large countries like the United States and Brazil, which are obviously two of the world's largest food producers, face these perpetual, insurmountable, really, droughts. So we have to think a lot about the impact that this volatility is going to have on our human geography and our immigration policies and so forth. The drivers of why people move, and therefore this has an impact on everything from real estate to technology to education and all of these other sectors in the consumer space and so on, are many, and they intersect and they overlap and they reinforce each other, like labor imbalances, political unrest, economic crisis, climate change, and so forth. And what people are looking for are the items that are listed on the bottom, right? Sort of, places that are more self-sufficient, that have resilient food supply, that are, politically stable and are affordable and so forth. And there is a need, I think we have to be clear about this, for a pretty significant correction between the geographies of, where we live right now versus where we actually can in a stable way, in harmony with nature, sort of live. And that is not something we're going to resolve in the next 1 minute, but it is something that I think all of us have to think about as we make our investment hypotheses that are covering the next 5-10 years forward. So final slide is really around this set of scenarios. Next slide, yeah. And this was done by Arup, which, as you know, is a major engineering infrastructure design consultancy. And they've sort of, painted, as one would expect, 4 pathways into the future. And there can be overlap among them, but I leave you with this in terms of things to think about when it comes to what decisions we can make and what impact they would have on these scenarios moving forward. I've tried to highlight a number of sectors that I see as green shoots, whether it is health tech, agrotech, energy, clean energy technology, and so forth. And should we make the right investments, it is possible that we move up and to the right in terms of this post-Anthropocene scenario. Whereas if we don't, then you can imagine that it's going to require more severe kinds of interventions later on. That's the greentocracy scenario. And the others are kind of business as usual versus an extreme extinction kind of scenario. And these are the 4. There's a lot of elements that go into making these kinds of scenarios, but what is, if there's any silver lining to the pandemic, it's that there has been, coming out of the emergency phase, a recognition that there is a deep linkage between the health crisis and the environmental challenges that we face, and the impact that smart investments today can have on what scenario we ultimately, or what path we ultimately wind up taking. So let me leave it at that, and thank you again very much, Mark. Thank you all for being here and for inviting me to join you.
Great. Thanks a lot, Prak, and thanks both, as you said, for giving us some thoughts on how the world could be different in a post-pandemic environment, and then also linking it, as we said, to the environment, which has sort of been shifted off the front pages these days by the virus, but is still with us. So I think how you ended is very appropriate. Now, just before introducing the panel, just a couple of more housekeeping issues. So I'm going to talk about the the panelists are going to talk about the various different topics. But if you want to ask a question, there's a Q&A bubble at the bottom of the screen. You can type in a question. and I will look to try to direct as many of those as possible to the panelists. One thing to note is we want to keep this on navigating the new normal for the finance industry. So I know there's obviously a lot of issues going around Hong Kong these days, but really that's not the purpose of today's webinar. It's really to focus on where we're going to get to in the new normal in the finance industry. We also will do some polling, a couple of polls throughout the webinar and the panel. So just keep an eye out for that, and please think about voting. So I want to take the time to introduce the panelists. We've got a number of really esteemed panelists. So Vip Vyas, who's the founding director of Distinctive Performance. We have Ashley Alder, who's the chair of IOSCO, also heads the SFC here, as you will know. We have Harshika Patel, Managing Director, Head of Strategy Asia Pacific for JP Morgan. Alicia Garcia Herrero, Chief Economist, APAC from Natixis. And then finally, Benjamin Quinlan, CEO and Managing Partner for Quinlan and Associates. So what we plan to cover now in the next 50 or so minutes is a number of topics. One is what will be the economic effects, including the finance industry. How will that impact the political climate, including domestic politics and trade tensions? How will regulation change to deal with its fallout? What are some of the risks? What has COVID-19 shown us about existing regulation? How will business strategies need to adapt in order to respond successfully to the new normal and to new opportunities and challenges? Parag already set out a few of the opportunities there. How will it change the operating model of an organization, ranging from the technology to workforce skills, which will be needed in the future? And then finally, what does it mean for financial markets, new products, sustainable finance, again, linking back to what Parag had already said, and compliance. So to kick it off, I'm going to ask Alicia to start us off as the economist on the panel. And she can probably follow on for what Parag had set us up to on is what will be the economic effects, including on the finance industry, and then I'll bring in the others after that. So over to you, Alicia.
Well, first, thanks very much for the invite. It's a pleasure to be here. I like to pick up a little bit on what we've heard so far as to what might be the economic impact of the whole thing. And I think there is two issues here. One is the short term, one is the long term. I would quite agree with what I've heard on the long term, the Asian century, the long term aspects of a further regionalization of trade and finance in Asia. Asia happens to be an obvious net creditor in the world, so why not just reshuffle all of these extra savings within the region? And I do think this is going to be the long-term impact. But before we get to the long term, as Keynes rightly said, we might all be dead, and that's what I want to focus on. So no matter how much the region may be ready to deploy these excess savings, through infrastructure investment or any kind of real need in terms of high return because of something that needs to be financed, the reality is that as of today, Asia doesn't count with a reserve currency to start, a really liquid offshore center, offshore or onshore, meaning big enough, not London, not New York. And as we speak, we are seeing obvious financial decoupling between the rest of the world and especially the US. And frankly speaking, I think very soon even Europe and some parts of Asia. And in particular, that is the case of China and Hong Kong. Of course, the rest of Asia is very different, but the reality is that this is the magnet for the time being for at least emerging Asia. And we have to figure what's going to happen with Japan, etc. So COVID-19 in a way just accelerates this trend of financial decoupling, which we're all seeing in a way quite dramatically lately. And I think this is really something that is going to be an immediate consequence in a way that we need to deal with beyond that very different scenario that will only happen long term. So the key really is how is Asia, and I'm going to focus on China and Hong Kong, going to deal with that financial decoupling that we're all seeing? There's a number of ways, I mean, that you could think can cushion this financial decoupling. One obviously would be the full use of Hong Kong and Singapore to kind of reshuffle those excess savings within the region and be able to finance all of the needs of these massive Asian companies, growing Asian companies. And to answer that question, we really need to know how much of that offshore, of the capabilities in terms of holding of savings of those offshore centers really come from Asia, which is very hard to know, I have to say, because we don't even have the data for Hong Kong, as some of you may be aware. It's very hard to know how much is non-resident deposits or other types of financial instruments, and how much of those non-residents are actually non-Chinese or non-subsidiaries of Chinese entities. So that's a very important question to understand what's going to happen. In the event that imagine, just for sake of argument, that those excess savings weren't regional to a large extent, we would actually see a very sharp increase in the cost of funding both equity finance and bond finance in the short run. What would that mean? Well, it's for all of us to see, but what we already see in the market is a widening of spreads, certainly for private companies, Chinese private companies issuing dollar debt here in Hong Kong. A number of things that may just accelerate. We also know that a lot of IPOs are coming from the US into Hong Kong. Are we ready for that? So for me, the first and immediate consequence of COVID-19, which is accelerated obviously for geopolitical reasons, is going to be how Asia is going to deal with this financial decoupling. And I know that Asia is very big and I may not have to generalize this, but I'm obviously focusing on China and Hong Kong at the current juncture. I leave it here because I'm sure that we'll get more chances to go through these topics. Thank you.
Thanks, Alicia. Maybe Vip, over to you, and if you have any comments on that economic effects, and then maybe also your discuss, maybe some thoughts on the political climate and domestic politics and trade tensions.
Yeah, I mean, I would, if we look at the whole conversation we're having today, it's in the background, it's really about the future, and one of the, I tend to look at organizations from the inside out. So, and when I'm working with the executives, what I normally say, well, if you're looking at the future, what matters most is what you're bringing into the present. So if you look at the media today and some of the comments that have been made, there's a lot of rhetoric which is around, look at what we've covered today, sort of decoupling, a shift from globalization to regionalization. So I think what's actually happening is that there's a shift in the structure of thinking. And I think when we look at, in particular with the trade war, which I don't have, we're going to focus on in a great deal of depth, Mark, but I know we had it on the as one of the topics. But I think there's a kind of like an emotional component to the rhetoric that's actually happening at the moment, which is going to obviously shape the way things happen in the future.
Yeah, thanks. And Hriska, do you want to come in on this point on both the economic effects and how the political climate and this point around regionalization? So maybe just some thoughts from you on it.
Yeah, no, just a point. I think Vip and Alicia pretty much covered it off. I think on regionalization, what's very difficult is so much of the supply chains, as an example, are interconnected. So it's very easy, right, to say, supply chains will decouple, everybody will nationalize. But the practical reality of implementing some of these changes is very, very difficult, both in terms of time it takes and secondly, the cost it takes to actually implement some of these initiatives. So, so that's all I'd like to add on that topic, which is saying one thing versus the actual reality are very different. And certainly, if I take last year as an example around the Hong Kong situation, to Alicia's point around, money sitting in Hong Kong, what we saw certainly as an industry at the beginning, there was a bit of flight of cash out of Hong Kong, for the first 2 to 3 weeks. but then, you know, the situation stabilized, everybody got comfortable, and suddenly that trend started stabilizing. So I think when you read, you know, something in the press, there's an automatic reaction, but actually people take stock. The actual long-term strategy changes accordingly.
Okay, thanks. And then maybe Ben, over to you before I go over to Ashley to give him sort of the final word on this. You know, do you agree with that? Do you think it's going to be challenging to decouple as much as, you know, we may be moving towards more of a regionalized environment?
Yeah, I mean, I see new factions and alliances naturally evolving on the back of what's going on geopolitically. I think the case with Hong Kong in particular, looking at the loss of, you know, special status by the United States, that announcement recently is going to put a renewed focus in particular on what that means for US companies obviously doing business here, but also any company that has operations that service Chinese national clients or the US clients within Hong Kong borders. And I think one of the implications in particular for financial services as you move into new realms of potential sanctions is what that means for AML compliance, KYC, cross-border activity, and what that might do in terms of thwarting the economic link between the nations even further. But, you know, I think it's still too early to say exactly what the end result of this will all be.
Okay, thanks, Ben. And maybe Ashley, over to you. I don't know if you want to say anything on the economic effects or political climate, but it'd also be good to get you to kick off on how will the regulation change, how will regulation change, if at all, to deal with the fallout in a permanent way. We've seen it change, obviously, around some temporary flexibilities. But what are some of the risks, and how will COVID-19 will show us about the existing regulation?
Yeah, well, you know, as a regulator, I'll stick to the regulatory aspect as opposed to the economic aspect. So, I mean, I think, I mean, a few things. I've been involved pretty intensively over the last now 3 months in the sort of collective global effort to address the crisis. And that effort has been located in a number of places, but from my perspective, I've spent most of my time with the Financial Stability Board. And that is, as some of you may know, it's basically a G20 group, but is basically dominated by finance ministries and central banks, but with a good input from market regulators such as us. So the first thing I'd say is that although from an economic perspective, regionalization is certainly on the agenda without any doubt whatsoever. And all the other components to that. What impressed me was the speed and but the speed at which global regulators pulled together to address the crisis, and the degree to which they coordinated. Now that wasn't the same as that didn't correlate to the speed and coordination of responses between nations or between regions. And there's quite a distinct difference between the two. But nevertheless, that's what happened. It was partly due to I think the difference, a significant difference between this crisis and the last crisis 10 years ago. That crisis, of course, originating within the financial system. This crisis, of course, originating as a health crisis, lockdowns, and an economic shock. And as a result of that, there were no atmospherics within the financial regulatory community to do with trying to work out who was to blame effectively, which certainly was a characteristic in the last crisis. And in fact, the whole sort of drive was to work out how could regulation blunt the economic shock, you know, to the real economies. And, you know, that was the first thing. Second thing is that all of you will have seen that the explicit overriding goal of the regulatory response was to keep credit flowing to the real economies and to keep markets functioning. The other thing that was quite apparent early on, which we all agreed on, and this was, you know, to an extent defensive, I suppose, but again, important, was to signal very, very clearly that many of these measures would not involve any rollback to the post-crisis reforms, the post-financial crisis reforms. save to the extent, but to the extent that there were inbuilt flexibilities to those reforms, this is the time to use them. And the best example is probably, draw down on capital buffers in banks. But added to that were measures such as restrictions on dividend payments and other ways in which to preserve lending firepower. Otherwise, I think there's also a view that many of the measures that have been introduced would be temporary, and those measures are multiple. We've got a repository, as it were, or a collation within IOSCO, and there's another one within FSB that goes into thousands of policy measures that have been taken globally over the last 3 months. Obviously, where we are at now is that, the major response was, setting aside the fiscal side, was central banks acting as purchaser of last resort of financial assets, and in particular in the bond market. We knew that we were primed for a potential collapse of a credit bubble in the non-financial corporates, and also a market valuation bubble, which has built up over the last 10 years. We didn't know what would prick that. And the interesting thing that's happening in the moment is that, of course, there were major repricing events in March in particular. But given the size and impact of the central bank interventions, we've now seen a remarkable recovery across asset classes. And the issue at the moment, effectively, or the discussion at the moment, is twofold. One of which is the gap between asset prices and what is happening in real economies, is that sustainable? And that links to another point, which is that the issue that we were dealing with in March was effectively a liquidity crisis, a major liquidity crisis in that dash for cash at the time. But the question now, which is occupying minds, is the shape and depth of a solvency crisis, which is already on us, and how you respond to that. Incidentally, the question around no rollback is linked to a view that we would not have got where we've got to so far in this crisis were it not for the reforms to the banking system, which has basically made banks far more resilient. But there are questions now around the limits of bank resilience as the solvency crisis deepens and as banks are being encouraged through various techniques to continue to lend into the real economy, which is under stress. And that, if anything, is the key point. In terms of, going forwards, there's a very interesting recovery phase, which will come on stream at some point, but it's not quite clear when the recovery phase kicks in. And the elements of that, of course, are very profound. One of which, of course, is to how do you pay for and unwind that level of central bank intervention? Because the central bank balance sheets do not resemble what they did. And secondly, there are issues around the ability of markets to price risk properly and associated issues around moral hazard. Again, all to do with the size of the intervention and its nature. But there's one thing I think that's come out of this, which everyone kind of agrees on, which is, actually, you can see it outside from the financial sector. There's been clearly there is discussion around resilient supply chains, and that goes to the question of regionalization, etc. Within discussions around the financial sector, this question of re-establishing resilience is seen to be really, really important. So in other words, the financial sector, providing a function of supporting real economies in a very positive sense depends hugely on continued resilience. And that as a prime attribute will be I think a central sort of feature of regulatory attitudes to the financial sector going forwards. So I'll leave it there, but that's basically what's been going on.
No, that's a great summary. I mean, there's a lot in there. Obviously, the no finger pointing, the no rollbacks, a lot of temporary reliefs, and then the challenges looking forward around how do we weed ourselves off of all of this central bank intervention, which has kept the markets, brought the markets back to being fairly frothy. Maybe just, from my side, there's a question here about what are the negative banking regulatory implications expected, such as sovereign regulatory protection. This view will help guide the advocacy efforts. So I guess in response to that, what I think what I guess they're digging at is, do we expect, the drawbridges to come up and protectionism to kind of come back in on regulation? And then maybe one follow up on that for me is, you mentioned a lot of the temporary reliefs and them being temporary. I mean, do you see anything that the temporary reliefs around work from home, et cetera, becoming more permanent?
Yeah, I mean, I think you can divide this into the kind of, the action from a prudential perspective, which is broadly the central bank interventions, the question of, which is at large, the question of the resilience of funds, amid liquidity pressures, particularly bond funds. So that's all on the prudential side. I think on the operational side, yeah. I mean, I think everybody recognizes that two things. Firstly, working from home with a degree of flexibility from the regulators around things like, recording of trades and things like that, and reporting, went far better than people would have thought, because of connectivity and technology. So because that is the case, I think we do think that many of those operational accommodations may continue. The problem is that some of the infrastructure, the technology infrastructure, isn't particularly well adapted to working from home, particularly in sensitive areas. So, you do have, there's no doubt that there is an increase in operational risk, notwithstanding the fact it's gone well so far. So I think there's going to have to be, a regulatory conversation around how that will be managed so we get the best outcomes, or the sort of outcomes we were used to when everyone was working off, basically. But yeah, I think you can split to the operational side of life, I think is likely to be a far more extended outcome of this than the other elements of regulation, which I think are temporary.
Great, thanks. I mean, maybe Alicia, back over to you. I mean, Ashley mentioned the issue around this starting off as a liquidity crisis and then moving into a solvency crisis, and in markets obviously being quite frothy. Do you have a thought or any thoughts on that you'd like to share? And maybe while you do, there's a question on here for Vip and Harishka. I mean, if either one of you want to take that after Alicia speaks, please feel free.
Well, first of all, I can't agree more. I think we should all thank the regulators for having given us the chance to bypass this liquidity crisis, especially in March. I mean, I have to say I was very impressed by the Fed's very swift action in terms of swap lines, well beyond actually what we saw in 2008, not only in terms of speed, but also even, broad coverage, because we also got into this major repo action, which frankly speaking has been very, very useful for a number of emerging economies. And that in itself is great news. The point is, we all know that the Fed can act as a lender of last resort for the whole world. And we also know that emerging economies in particular, I'm going to focus on that at the moment, don't really have the IMF is balance sheet size that would be needed for that liquidity issues to be fully solved and avoid any solvency issues. So there's two things happening here to go into your point. One is that we will have solvency problems, and therefore liquidity measures can't solve those solvency problems because the economic impact of COVID-19 is being massive. and this is corporates, but it's also sovereigns, as I mentioned, in the EM space in particular. But the other one is that because those liquidity problems can't be really solved, more structurally, forget about them becoming solvency problems, in the sense that the IMF is not there with the right size, and we know how hard it is for the IMF to actually, become or be recapitalized at the current juncture. It's just that impossible not to avoid some of those liquidity problems becoming solvency problems. So there's two issues around, and I think we should all be working, quite frankly, on maybe speedy types of sovereign restructuring. Let alone probably at least EM corporate debt, being treated in a way that can be at least managed more in blocks, because a lot is going to come to the market, and I don't think we're ready for this. So I do think this is a big issue. We've talked about this, especially sovereign, for many years at the IMF, and we don't have. We've tried many options. We don't have the silver bullet at the current juncture. Neither for bailout, as I said, because the funds are not there, nor for market-driven restructuring processes, which we did try with, all kinds of CACs and SDRM, all of those acronyms that we even forgot. But now we need them. And nobody's even kind of, undusting those concepts and bring them to the table. So I do think we're not ready for this sovereign wave, which I can't agree more with Ashley, is coming. So yes, indeed, very important.
Thanks, Alicia. Maybe Vip and then Hariska, any comments on this?
Yeah, so just looking at the question. Yes, I think the main thing I would say is that, the perception that's getting created tends to be the driver of action. So the thing about fake news is that clearly it's very, very difficult to actually, I think people are struggling to actually understand really what's going on. That's the kind of the complexity of the situation at the moment. Mariska, I don't know if there's anything you wanted to add to that.
No, I think you've covered it off, so nothing to add.
Okay. Well, anything on the regulation side that you want to add, Hariska or Ben, on what Ashley said, or your thoughts on how things may change?
No, so certainly, once again, certainly speaking from a bank's point of view, a big thank you to regulators, frankly, all over the world, both in terms of, supporting liquidity in the market, supporting our clients, supporting how the fact that everybody's had to work from home. There's been a lot of complexity, both in terms of operationalizing how a bank actually works in this environment, together with ensuring that we work with our clients to support them in their day-to-day needs. So certainly, from a bank's point of view, we have been extremely heartened with the prompt and swift action that regulators all over the world have taken, and how they've actually learned from one another.
I think one of the other things I want to add is, a lot of the regulatory support and liquidity events have obviously helped, I would say, support the cost base or the cost concerns of many of the organizations during the past few months. But one thing that hasn't been solved is revenue, right? Where does the spending power come from? And you can solve as much of the cost outflows as possible in terms of interest payments or guarantees. But the bottom line is, when spending dries up and you've got such huge mass structural unemployment and a crisis of consumer confidence, it doesn't matter how low you bring your cost base. You've got no revenues coming in, or your income levels are dried up. There's a major problem. I think one of the other things coming out of this is how you're splitting up, I guess, the fact that in the big end of town, the large corporates stand to benefit much more than the SMEs and small businesses that are being impacted by this the most. As a result of that, I look at this event as not a potential trickle-down benefit. We've obviously seen that the trickle-down has not happened. This is a Main Street to eventually what will be a Wall Street problem in the future.
Okay, thanks, Ben. I think that pulls us into the next question around business strategies. But before I do, maybe we'll bring up the poll question, the first poll question, if we can bring that up. Yeah, so here it is. So everyone says that this tech that says that tech will be the new winner from this crisis, given the rapid move to digital. Who do you think will be the biggest relative winner in the tech space from this crisis? And there's all the various answers down there. So I'm going to let you basically answer that poll. And while we do, I'm going to go back to Hriska and ask her, how does she think the business strategies have been changing, and how will it need to adapt in order to respond successfully to the new normal? Ben mentioned obviously the decreasing amounts in revenue. We saw some things from Parag on the new opportunities and challenges. So wouldn't mind getting your view from JP Morgan on that.
Sure, thanks, Mark. Okay, so from my vantage point, I think there are two key impacts on the business strategy, speaking from a bank's point of view, and a bank that also has an asset management business as well. The first one is the way we work, and we're touching upon it in the next section as well. But it's not simply just work from home way we work, which will clearly have both cost motivations attached to that, together with the whole wellness and talent agenda. There's also the whole element of how we interact with clients. Certainly, if I'd spoken to a banker or a salesperson or any client-facing individual in 2019 and asked them to cut their travel expenses or their dinner allowances, they would have all had an allergic reaction. It's amazing now, over the last 3 months, how everybody has managed to still speak to their clients, have very contentful discussions using the medium that we're using today to do that. So in a go-forward environment, whilst absolutely travel will commence, dinners will commence, in-person meetings will commence, I think people will be a lot more targeted in terms of how they use these type of mediums to have meaningful discussions going forward. I think the other thing, just sticking on that theme of work from home, I think, it's no shock to everybody that financial services as an industry has typically lagged, say, the tech firms or the consulting firms in how they've embraced flexible working in scale as an initiative. We all know what the benefits are. I think what COVID has done, it's created a real cultural mindset shift in the minds of all of these organizations that people can work from home, they can work flexibility, and at the same time, they can be very, very productive with it. So I see that whole one dimension coming out of COVID. I think the other key point I want to raise now and really focus on is, from my point of view, I don't think COVID will change what the key priorities of the banks or the asset managers have been, frankly, since the GFC. Right, so their priorities pretty much were balance sheet resiliency, as Ashley mentioned, post-GFC, winning client share amidst an increasing competitive landscape, new competitors coming in, controlling costs amidst all this margin pressure that we're seeing, raising capital and compliance cost. For me, what's changed is COVID has added another dimension, which is our clients have had to behave differently. And what I mean by that is, we talked about how they communicate with us, but now they've had to open bank accounts electronically. They've had to do all their trade finance business electronically. Previously, that was very manual. They've started transacting with us electronically. So all of these priorities that the banks had set themselves previously, to my mind, all still stay. It's just we need to accelerate as our clients have got used to working in a much more efficient fashion going forwards. So as I look at this crisis, I've split this up into two themes: the good news and the not so good news. So as we look at the good news going into this crisis, as Ashley mentioned, capital ratios have never been stronger. Pre-GFC, that were the 7 to 9% tier 1 ratios. Now we're at 12 to 14%. So very, very healthy as an industry. Whilst provisioning, we've seen it all in Q1, and I'm sure we'll see more in Q2 and Q3. Provisioning will hurt the balance sheets of many of the banks. The top line, certainly for Q1, and we're hearing for Q2, are remaining relatively resilient thanks to the volatility and the client activity that we've seen off the back of it. We talked a bit about leverage. The good news is, whilst the world has taken on a lot more leverage in the past 10 years, and that's pretty much the government's, from the bank's point of view, there's a lot less leverage in the banking system. And then, as I mentioned, this whole remote working for clients has created a real mindset shift in their mind on how they deal with us. Now, The not so good news, which takes me to then why I feel that the priorities really need to remain what they have been for the last 10 years, but just in spades now, is since 2009, those global banks have actually struggled to get back to their pre-2009 revenue and profitability levels. There are a few outliers, right? But to the point that Ben made, revenues have still struggled, right? We're going into an environment now where interest rates, back in 2008, US interest rates were 5% and went down to 0. And then in the teens started to come up. Now we're at US interest rates of around circa 1.5%, and people are talking about negative rates. As you can appreciate, whether you're a bank or an asset manager and you take in deposits as part of your lending business, as part of your custody business, as part of your treasury services business, all of these businesses are going to have huge headwinds to the margin that they've historically had in those businesses. Margin compression then, on top of the low interest rate environment, continued also to erode banks and asset managers' revenue base. It's very interesting to see with the advent of electronic trading, equities volumes, FX volumes over the last decade have gone up exponentially. We're talking in the arena of 40 to 80%. Yet if you actually look at the actual wallet, the revenue wallet that banks and asset managers have earned off the back of all of this increased trading, actually that's down. So, you know, commissions are hugely down, execution fees that clients are prepared to pay are hugely down. It then doesn't help that in this arena of everyone's trying to acquire clients, retain those clients, you have some brokerages, you know, who've gone to 0 commission to do some forms of trading. Now, historically, some of those business models were predicated on higher interest rates. Those business models are going to be challenged now as we think about 0 and negative interest rates in a go-forward environment. And then when you look at asset managers, they've got the added complexity whereby they've seen a huge shift over the last 10 years of clients being happy to pay fees to be in active funds, right, to now whereby we're pretty much 50-50 in the amount of AUM that this industry sees between active funds and passive funds. So the story there being one of huge revenue pressure in a go-forward environment, and to my mind, further exacerbated by what COVID presents. So how do they focus on what they've already started doing? I think just 3 or 4 points to mention. Scale, right? If you are a bank or an asset manager that has scale, you will ultimately be the winner out of this crisis going forwards, because scale enables you to invest, it enables you to be innovative, right? And where the name of the game is basically acquire a lot more clients, go deeper with those clients, cross-sell a lot more to those clients. If you're able to give your client a good experience, a timely experience, liquidity when they need it, they will come to you. Now, historically, scale always meant M&A, right? Let me go and buy somebody else so that I can get more of a branch network, I can get more clients to give me the scale that I need. Actually, if you look at what's happened over the last few years, M&A for that purpose has actually been complemented with technology as a solution or partnerships as a solution. So if you just take Asia alone and you look at some utility companies in Singapore, some ride-hailing companies, a lot of them in the past couple of years have announced partnerships with banks, right? Banks have the product, a ride-hailing company has the client. It's a perfect marriage for the bank to sell their products through the ride-hailing company. So I think going forwards, we are going to see a lot more of these partnerships where product providers will partner with people that have the clients to scale and grow their client base. I think the other point in this environment to stay relevant to your clients, and once again, it's something that banks were doing previously and will do more of, is to keep the client. It's all about the value-added service, right? What the whole COVID situation has highlighted, particularly in a fragmented region like Asia, where we have a lot of restricted markets, is this whole concept of virtual banking, right? Previously, it would have taken an MNC or a corporate in a smaller country, say like Vietnam or Malaysia, right, days, if not weeks, to process their custom payments, to process their tax payments, right? Virtual branch networks, partnering with the regulators, has enabled banks, together with the clients, to reduce this 1 week, 2 week cycle into something that can be solved digitally in a 1 to 2 day time horizon. So once again, it's a way of staying focused on your clients. I talked a bit about electronic execution. I think it's worth mentioning. It's a topic that we all have heard a lot about over the last 10 years in terms of how banks and asset managers have invested in electronic execution capabilities. Banks that actually had strong capabilities saw in Q1 a lot of those volumes come to them. The interesting statistic that I read, though, is that where previously clients may not have embraced electronic execution as means of doing business, but may have preferred to call someone at a desk, this year we've actually seen year on year huge uptrends to the tune of 20–30% increases in the number of clients actually wanting to be onboarded to electronic venues. I think the final point just to raise on revenues before I just talk a little bit about costs is non-core businesses. I think in the past 10 years, financial services industry has had the luxury of potentially hoping that some of their non-core businesses could become core businesses. I think with the revenue pressure that I spoke about, what we're now seeing, certainly in this region, is a trend whereby if you're a good retail bank, if you're a good wholesale bank, and you might have an insurance arm, right? Let me just sell that small insurance arm and sell it to someone that knows something about insurance so that I can use that capital more wisely, either in my retail banking business or my wholesale banking business. In Europe, they're thinking of something slightly alternative, a lot more talk around consolidation there, right? You've got European banks whose PE ratios are sub 0.5%. Interesting stat for you all, for every 82,000 people that live in the EU, there's actually one bank to serve them. So 82,000 to one bank tells you there's actually a lot of banks in the EU. So no surprise there. People are heavily talking about the consolidation agenda and regulators actually being quite supportive to that trend. So that's the whole revenue piece. I think on the cost piece, as I mentioned at the beginning, there's been a huge focus on costs over the last 10 years. Regulation, capital, compliance cost, all this post-trade reporting costs have added a huge dimension to the cost agenda, which now becomes more relevant with revenue margin compression. The bad news is that back in 2008, banks had a higher variable cost structure. You know, we're talking about 35 to 40% of their total cost base was variable. You can do much more with a variable cost base. Coming into 2020, we're looking at a variable cost base about 20 to 25%. That means these banks need to be a lot more radical in terms of how we tackle costs. And, you know, deprioritizing digital initiatives is not the answer, because that's the way that you're going to actually protect your revenues. So now what we're seeing on the whole cost side of things is people being a bit smarter on how they use utilities to outsource a lot of their BAU processing, which otherwise they might have done previously. Managed services companies, which once again, they can outsource certain services. And the third one is actually product simplification. There was a time where if a client knocked on your door and said, please build this for me because I need my information that way, I want to look at my screen this way, banks or asset managers might have built it for them. I think we're in an era right now whereby focusing on profitability means we need to look at how we continue to simplify the product. So with that,
Hriska, yeah, I think I'm going to have to interrupt you to get a couple of the other guys in, if that's okay. Okay,
Yeah.
So Vip, I wanted to give you a chance to kind of, Hriska covered a lot there, and the poll result, I think people probably see the communications and workflow collaboration tools was the #1 followed by e-commerce platforms. And I think, as Harish just said, off the top, I mean, a lot of this travel, we haven't had to kind of, hasn't, you know, if you tried to cut people's travel a few months ago, they would have gone ballistic. But now we've been able to kind of deal with this in that environment. So that's kind of reflected in the poll result. But, you know, wouldn't mind giving you an opportunity to kind of say a few things on this topic.
I think she's done a very good job in terms of laying out the landscape of both the top line challenges and the cost side. We have I think we have got another poll, which is really giving the attendees an opportunity to look at how is their own organization dealing strategically. So is that something that we could put up now?
Yeah, I can put that poll up now if you want. So if we could put the second poll up, please.
It'd be interesting to get the results from this.
I think we'll have to give it a minute or so. So Vip, perhaps continue talking, and then we can look at the results.
It'd be interesting to see the results because at one level the questions may seem fairly innocent, but we've actually shaped these questions. You know, when you're facing a crisis type of situation, there's a sort of psychological place where people go. So these questions have been drawn from 3 different psychological places where organizations could go to. And the 3 psychological places I think most people are familiar with, you know, either people get very frozen, or they get very aggressive, or they get very creative. So it'd be interesting to see the response. One of the things about when we get the results back is that the output will actually be shaping the operational structure of the business. So it'd be interesting to see what comes out of the survey, because the operational model of the business, you know, at the moment ranges from going pure digital to, you know, the other sides, you know, where it's sort of, you know, you've got a lot of physical assets. So I'm just, you know, curious to see how effective people perceive that their own leadership teams are managing this period.
So here you go. Seems like increased investments in digitization takes it, but it's pretty close between that and increased focus on overhead and cost reduction, and we'll review business strategy once things can become a bit clearer.
Yeah, and it's good to see that you know, not many are frozen, you know, in a state of frozen state. But also you can also see that quite a few businesses are actually also looking at waiting to find out how things develop before they sort of look at their next strategic review, by the sound of it from this.
Okay, so maybe Vip, anything else on that, or I'll hand over to Ben to kind of bring in the operation model and arranging for technology to work for skills. So over you, Ben.
Yeah, I mean, just picking up on the actual survey results, which is digitalization and overhead and cost reductions, I think it dovetails nicely into what I want to talk about. I actually just got off the panel before this talking about our most recent research publication, which is basically saying COVID and the circumstances around it has made the digital transformation journey become what was once a strategic priority to now just an operational necessity. So we estimated that 2019, corporates globally spent about $510 billion on their digital innovation efforts. We expect that to dip this year as people kind of focus on their immediate core priorities. The move to tech around Zoom and so on is not really what we'd call innovation, but over the next few years, as the world enters this new normal, consumer behaviors change, employee habits change, there needs to be a big revamp. So we expect that to actually double to over $1 trillion by 2025. And the drivers, you know, we're talking about changing behaviors with shopping, transacting, communicating in different ways online. The point about work from home and flexi work arrangements, I know I've had to institute that. You can see I'm at my home now. Twitter, for example, announced that, you know, people can work from home indefinitely. They don't need to come to the office again. In markets like Hong Kong, in particular, where real estate costs are so high, it's quite obvious that people will kind of look at this as an assessment of, should we actually create a more flexi workforce to reduce that part of our overhead, which is quite punitive in terms of our operating costs. But overall, you know, this whole revamp and move to online is really signaling a need for a greater focus on renewed cybersecurity. It's very clear that people are much more at risk of hacks and threats. BCP, business continuity planning and management, what was once boring has become sexy again. It's remote management, remote workforces, and so on, crisis teams, management tools. I think a lot of companies were, maybe except for the banks, which are very well prepared, were caught off guard by this crisis, and they really found themselves in a bit of a productivity deadlock for a little while until a few key things could be sorted out. And in particular, communication remains a real important aspect of that, how you communicate your crisis management and how you position your business to respond to what we call this new normal. We touched on earlier themes of kind of de-globalization. I think everyone keeps reiterating that, the impact on supply chains. So it'll either do one of two things, depending on where you are. You'll diversify your supply chains to different countries as well, or you will bring those supply chains back onshore if it's economically feasible to de-risk, especially around the international leg of where you source your goods and services. Revitalization of crypto, actually, if there was ever a time for cryptocurrency to make a revival, it's probably now. Ashley touched on it earlier on, which I 100%, I've shared many views on this around the impacts of QE and the mass printing of money. Is that really putting fiat as a currency under pressure? Are people losing faith? And again, the CB intervention has not actually staved off any of the mass unemployment that we're seeing. And many people think this is cyclical. It's not. A lot of it is structural. And as a result of that, you've seen markets rebound, asset prices kind of reset close to their pre-crisis peaks, which has obviously insulated the wealth destruction of people that can invest in those assets, which is usually the wealthier income society. But mass structural unemployment among the masses, people in gig economies, low-income workers, this is a real problem for that part. So it's actually created a widening wealth gap, which is going to, maybe re-spur the interest in, is there an alternative way to get out of this kind of QE crisis, so to speak, because it's creating, as Ashley mentioned, major moral hazards in my view. And you're actually seeing renewed institutional fund interest in this space. I know there's a question on the chat group regarding ESG. I do think this will act as a tailwind for renewed focus. I think there's obviously been a lot of narratives around how these lockdowns and travel restrictions and so on have actually benefited the environment, and it's come to the world's attention. So this will inevitably be used as a springboard to kickstart that discussion once again, and ESG is inevitably in full flight. I think more at the weed level, I'll just finish off with this: cost control, protecting revenues, and then maintaining productivity and morale. So cost control, people are like doing everything in their power to renegotiate rents, speak to employees about, part-time work, unpaid leave, engaging with their vendors and suppliers about discounts. There's refinancing options with financiers, cutting fringe expenses, everything that you can do for free online. It was interesting to talk about the benefits of Zoom. I know many companies still haven't got a paid Zoom account. So, they're still doing whatever they can for free. Protecting revenues, that's the other side of it. It's really around companies, and Hrishka touched on it as well, thinking very carefully around your proposition based on how your clients are responding. So that could be around your delivery timelines, your scope of services, your formats, and your actual prioritization of client deliverables, and getting your mission critical tasks done first. And then I think there's also a rethink around pricing models. People understand that cash flow is something that is, obviously front and center priority right now. So I've seen many companies look at stage payments, milestone fees, payments in equity, and so on. So different models to cater to their clients' evolving needs. And then the final point, productivity and morale. This is something I think is very important because, the migration to online, it's actually had an impact on some of my staff. I know some have gone mental working at home in their apartments in Hong Kong because it's just so small and cramped. They've actually asked me, can I come to the office? So I've said, sure, and I'll come with you, no problem. But I think the whole idea around how this is impacting the psychology of the way people think, some people are benefiting very well. The introverts in my team are in full flight. The extroverts are suffering really badly, including myself. So how do you manage and maintain and ensure that virtual management, team productivity, and morale can be achieved? And people, I think some companies are forgetting what this means for setting guidelines, expectations, maybe adapting responsibilities, and actually ensuring that there's, I would call it a human factor to reaching out to your staff and making sure they are engaged and productive and feel part of a team when they are not really around anyone or haven't been for so long. I'll stop on that.
Okay, thanks, Ben, and thanks to all three of you. I think you set out a lot of the challenges around strategies and the operating model. I was going to give the last word to Ashley, but I think he had to drop because he had a hard stop. So maybe Alicia, I'll give you the last word quickly. There's a couple of questions on here around U.S. unemployment rate, as well as around how do we get out of this debt buildup that we've had to kind of build for the to get us through COVID-19. So maybe if you want to address those or make any last comments, then we're gonna have to cut it off, actually, unfortunately.
Sure. I think I'll be quick. There's two types of reactions to COVID-19 in terms of fiscal policy. Monetary policy, we all know that it's all about QE if you can, and try it out if you don't think you can. So that's what it is. But for fiscal, I think there's two models. One is basically the US, which is not directly focusing on unemployment, but rather, companies making sure that their credit is cheap and so on. And the other one is Australia, to a large extent, I would say even Europe, in which you put the money directly in the pockets of the households, either through helping them finance their mortgages, or even directly covering their wages. I actually think the latter is a better approach, because indeed this is an unemployment type crisis. Is a crisis where it hits directly the households. It's very different from 2008. And I think there will be different. By the way, if I have to add, China has indeed very, quite a hard time in directing the stimulus to the households for reasons that we know very well. Basically, it would go all, more in the way of the US, although with different policies. So investments still today, infra, government bond issuance, but it's not really protecting the household's income. So I think this is a very important difference to look at what may happen next. And I think, countries that are not focusing on households will have to. So we'll see a reshape of a lot of this stimulus more into the household sphere to avoid the massive consequences on consumption and therefore. So yeah. I know that we're short of time, so I just wanted to focus on that. Big crisis for the households, we need to focus on that with our fiscal stimulus, and not every country is doing this now.
Okay, thanks, Alicia. And I wanted to thank all the panelists. Sorry, Ashley, you're back. If you wanted to have a last word, you can. On the regulatory side, I thought you had to drop off, so I can give you the last word if you want. I think you're on mute.
I'll leave it there for the moment. I think
okay.
I won't spoil the quality of the other remarks by saying anything more.
Okay, great. Thank you. So I just wanted to say thanks to everybody, and thanks to the panelists. I think we covered a lot of ground. We could have probably had a full day event on all the different various topics. So thank you very much. We've got a number of things coming up. Next week is the China financial markets post-COVID-19. So please, if you're interested in that, please register. We have a great economist from HSBC, Fred Newman, kicking it off. And then we've got an equity panel and a fixed income panel talking about how COVID-19 is impacting China. So that's another 90-minute program. So please register now if you haven't already. So again, I wanted to thank all the panelists and thank everybody for attending. We were well over 400 at some points during today. So thank you very much for your time. Thank you.
Thank you. Bye-bye.